In today's video, we will take a look into consumer producer inflation, personal consumption index, unemployment rate, some historical data, and also rate cuts and what to expect. My name is Anna Eckstein, Coldwell Banker Realty, Ultimate Luxury Group. Let's start. All right, so let's start with this chart, Fed interest rate decision. So this is our third rate cuts for the 2024. And the Fed indeed cut the rate by 25 basis points. As you can see on September 18, they cut by 50 basis points. November 7, they cut 25 basis points, and another 25 basis points they did cut on December 18. Now, what changed? We all expected this rate cuts. What changed? The major change actually that happened on the last meeting. The projection, and you can see actually, here's the projection for the 2025. And obviously, a 5-year projection. So what major thing change that they expected in November meeting, we expected actually the Fed expected to cut the rates, 4 rate cuts in 2025. And the major thing what happened, they actually decreased those rate cuts for 2025. And now we're expecting only 2 rate cuts by 25 basis points in 2025. And this you can see actual projection. This is where actually expectation of the rates will be in 2025 by the time they will cut. Right now, the Fed, the rate, base rate is actually roughly is 4.5%. So expectation would be around the 3.94%, right? And this is what we expecting now versus that was 4 rate cuts in the prior meetings. So, where are they coming from? So they're coming from, they would still feel inflationary data coming in stronger than expected. The GDP projection, you can pause and you can take a look what the projection would be for 2025. So we're still a 2.1% projection. The 2026, 2.0, 1.9 in 2027, and longer run, we're still expecting at least 1.8. Now, this is the obviously Federal Reserve Board members' projection, right? And you can pause and you can take a look. The unemployment rate, we still see that even for longer, we still technically, historically, is on the lower side. And you can see projection for 2025 would be roughly is 4.3% unemployment. The PCE, that's the projection. It's the most preferred gauge for the inflation for the Fed. And you can see the projection of that for 2025 runs 2.5%. The goal, ultimate goal for the Fed is to bring the inflation to 2%. So we'll see obviously what will happen. So if we take a look to see, this is something many of us expected that, well, now rate cutting the rates, Fed cutting the rates, and now we all will have a lower mortgage rates. Well, that's not as simple how it works. So Federal Reserve, when they cut in the rates, they cut in the short-term rates actually for the Fed. And those rates spill out in the short terms, like 2-year, 3-year, things like that. The longer 10-year Treasury yields is actually what they control the mortgage rates, those longer terms Treasury yields. And those ones, Fed technically has no control. Who has the control is obviously the market. And the market says, well, Mr. Powell, we don't believe you. I think the inflation is still running on a hotter side, and we just don't believe you. And this, as you can see, I actually decided to go back and see, this is actually 2024, and you can see the highest actually 10-year yield that we had was in April 25, 25th, it was 4.7%. So before the starting cutting rates, the cutting rate, first rate was 50 basis points, was September 18. And you can see the lowest the 10-year yield at that time was actually 3.62%. And right now we're right around 4.60% on a 10-year yield. And now, where we at as far as the mortgage rates, right? So the way how the mortgage rates is, we have a 10-year yield, and then between the mortgage rates, that goes the spread. The spread basically that's the interest rate determined by the banks. And you can see that technically the spread generally runs 1.5%, was pre-2008. I went back in history, take a look, and on average, post 2008 and for the 2020, it runs roughly 1.75% to 2%. And so where I go with this, if you're wondering, like, who really cares about this yield? Well, hopefully, if the Fed will be dropping the rates, their fund Fed rate will be dropping by 250 basis points, and let's say the spread will go down to, let's say, so if you wonder how much right now, roughly it's about 2.3%, right? And if it goes down to, let's say, close to maybe that 1.75 between those two rate cuts and the spread goes lower, hopefully then obviously the mortgage rates will go lower as well. So that's the reason why I'm sharing with you this information. So during the COVID, you can see that the spread was between 1.4% and 1.6%. And the higher spread we had in 2023 as high as beyond the 3%. So that's where we at. So the key factors why the spread can increase or decrease, it's obviously the risk of the mortgages. They're much more riskier than treasuries, so there's higher yield would be asked for that. Also liquidity. And also when the Fed is doing QT, which is they don't the spread is actually widening at that time because there's Fed is not supporting as much mortgage-backed securities and takes the liquidity from the market, and that's how the spread goes higher. So hopefully as we continue going, hopefully inflation not gonna go to reaccelerate in 2025. So hopefully between the spread maybe go down and the Fed continue cutting the rates, we will see a better mortgage rates than obviously we have right now. So that brings me to another chart where we at right now with the mortgage rates. I would like to share with you the MBA mortgage rate and actually 30-year mortgage rate. The difference is how it's being calculated, but they are pretty close to each other. So the 30-year MBA is actually calculating on confirming loans balances, 766,550 or less. And this is as of December 27, 2024. It's rose to 6.97%. And also I decided to take a look, and I like to compare with the historical data. So if we take a look, the highest mortgage rate that we had in 2024 was on April 26, 2024. And that was 7.29%. The lowest we had is 6.13, and getting close to the 5% right before the Fed started dropping the rates. And, once the Fed started dropping the rates, our mortgage rates, unfortunately, it actually went up. So, and here where we at 6.97%. So, of course, mortgage applications plummeted by 12.6%. I mean, that's expectation, right? Mortgage rates higher. Not that many people would refinance at these rates, obviously. So the 30-year mortgage rates is, quick explanation, is the average rate on 30-year fixed mortgages backed by Freddie Mac. Rose to 6.91%. And this was as of January 2nd. So like I said, they're both pretty close. And you can see that those rates, the highest we had May 2024, 7.22%. This is where we at. The lowest we had 6.08. Gosh, those rates were so close to get under that 6%, but unfortunately we never got there. Hopefully we will get there, in 2025. We'll see. Not that many predictions, and I will share a chart with you just in a little bit. So the 10-year yield Treasury, this is I wanted to compare, to share with you historical data, is actually the highest yield that we had was July 1981, was 15.82%. And you will see shortly what the mortgage rates was look like. So I think we shouldn't complain that much right now, even with these higher mortgage rates, right? So the lowest actually was at the COVID 2020 April, 0.65%. So this is amazing, actually, how the history kind of take a look. I always like to see the data. So 30-year mortgage rate. 30-year mortgage rate is the highest that is being recorded. It was on October 8, 1981. Can you guys imagine 18.63% to pay for the mortgage rate? And this is, we're talking about 30-year mortgage rate, right? Like in yourself for 30 years. I mean, obviously, when mortgage rates was going down, people would refinance. That kind of makes sense. And the lowest, right, if you ever wonder what it is, I'm sharing with you, it was December 23rd, 2020, was 2.6%. I mean, that's amazing. Like if you, I mean, I don't think we'll see anytime soon in our lifetime, but I mean, that was just definitely, I mean, whoever like in those rates, those 30-year mortgage rates, I can see why they don't want to get refinanced right now. I'm just kidding on that, but it's amazing rate. Congrats if you're one of the people who has those rates under 3%. So this is prediction by Fannie Mae, MBA, Wells Fargo. So this is what they're projecting where we can see those 30 years going in 2025. So obviously, any projections is subject to change, as we all know, but this is where they think and where they're going in. So on average, they still think, overall, every single one think that in 2025, we will not see the rates in 5%. If I have my 2 cents, I don't know. Like, I feel like our consumer is just getting weaker and weaker, and think about of all this, trillions of dollars that needs to be refinanced. Actually, I have, this is my next slide. So think about what would be interesting for the 2025. So nearly $3 trillion of US debt is expected to hit maturity in 2025. I found this article on CNBC. So decided to share. I mean, this is going to be interesting to watch because I don't know. It's just our economy is just right now. It's one big debt bubble, and all of this debt needs to be refinanced. And I think the Fed, even they said like that's how I feel at least. And let me know in your comments how you feel. I mean, they say, yes, we only will be dropping 225 basis points in 2025. But think about all of this debt needs to be refinanced. This interest rate has to go down. I think unless something really, really crazy inflationary, which I will share with you momentarily, can go really, really crazy. I think that will, I believe that they will drop the rates more than 25 basis points twice. That's just my 2 cents to this. So anyway, where are we at on inflation? So inflation year over year is rose right now. Where we at is 2.7%, and we rose month over month 0.3%. Or it's excluded volatile items like food and energy, and that's 3.3% and rose by 0.3% month over month. So remember, again, the Fed would like to see that 2%, right? So and you can see also how we're going in July and August and then start a little bit reinflation. So that's why they changed a little bit of strategy of how many more rate cuts we will have in 2025. So this is something interesting data I would like to share with you. You can see this is of the history. I'm thinking like, okay, so where we were with inflation year over year, right? And core inflation year over year. So the highest inflation was interesting because It was 1947, was 19.7%. Guys, can you imagine that? And then I was looking at 1932. Gosh, we're going in totally disinflation of minus 10.7%. In 2009, it was minus 2.1%. And the 80s, I don't remember if we talk about on this channel, but that was a lot of the inflation. And this is what I think the government is really, Fed is really cautioning right now how they handle this inflation, because you see how these two spikes. So they in the 70s, they deflated the inflation, but then inflation again reaccelerate to even higher than we had. In 1980 was 14.8%. So if you wonder where we were the highest on inflation in our time, it was 9.1%, and that was the June of 2022. So right now we at 2.7, right? So we getting there slowly, hopefully we're not going to have any hiccups in reinflation. That would be obviously devastating to the US economy, in my opinion. So on a core inflation, the highest we were 13.6% in 1980, and right now we're 3.3. And the highest that we were in 2022 was 6.6%. If you like to pause, this is the chart I always provide with all my market reports, economic data reports as well. This is the inflation that was recorded and the breakdown by the items. Over here, it's month over month. So the producer price index, why I share this with you, because anytime when the inflation goes on producer side, eventually will spill over to the consumer. So it's important data to understand and take a look where they're going in with this. And it's rose to from 2.6 year over year rose to 3%. So that's where the Fed is looking. These numbers, we were doing so well, August, July, September, and then now we start going in that reinflationary mode. And I think they're really trying to be very cautious. And 0.4% month over month, that's how much it rose. Core, we now at 3.4, and month over month, 0.2%. So PCE, this is the preferred gauge of inflation for the Fed. And annual PCE inflation personal consumption index rose to 2.4% and 0.1% month over month. So core is at 2.8% and month over month rose by 0.1%. And this again, I just pull up the data. I just thought was interesting. In 2022, the highest for the PCE year over year, we were at 7.24%, and the lowest we were under 1%, obviously under half a percentage, is 0.44 in April 2020, and core, the highest 5.64%, and the 2020 the lowest was 0.9%. This is for the core. And this is the more brighter historical data. We have in March 1980, 11.59%. We were negative on PCE in 2009, minus 1.4%. And for the core, again, in 1975, it was 10.2%, and the lowest that we had, 0.65% in August of 2009. So retail sale, where are we at? Health of the consumer, well, we'll still keep going in there. 3.8% increase year over year, 0.7 increase month over month. And so the way how we look in this data, obviously the data is coming in month behind. So we look in this data for the November, and pretty soon I'll be updating you for the data for the December as well, at the end of the January, obviously. So personal income over month rose by 0.3%, and the spending is rose by 0.4%. Non-farm payroll. So where are we at? So obviously the Fed is concerning a little bit about the jobs, because they just want to make sure they dual mandate is job stability and inflation would be met on both sides of the dual mandate. And that's the reason, well, that's at least what they said, that the reason why they start dropping the rate, and they wanted to be to a neutral rate for the Fed. And you can see also, so non-farm payroll, we had, it's interesting because I remember it was funny, the August jobs. The first one, they came in September, and they said, well, August job was, I think, don't quote me on a number, but I think it was like around 145,000 when they reported for the August. Then the next month, they actually revised up by like 10,000 jobs. It was like 155 some thousand. And then the following month, they revised to $78,000. I mean, 78,000 jobs. So anyway, I just thought it was interesting. I just remember that revision because it was keep going back and forth, up and down. And so this is where we at. We created in November 227,000 jobs. And the unemployment rate ticked up from 4.1 to 4.2%. And it's still historically low as far as the unemployment. And I will share with you the chart shortly. So the highest, I was just going in for the 3-year period, and I'm thinking, what is the highest that they created in a single month jobs creation, right? And that was 862,000 jobs. It was created in February in 2022. And the lowest, obviously, was October of 2024, 36,000. So this is just a breakdown. Obviously, government jobs were being on uptick for quite some time. It's not a surprise for anyone. Manufacturer being suffer, there's no really surprising on that as well. And this is our non-farm payroll private jobs. This is where we at. So you see in October, we actually lost 2,000 jobs. This is the chart. So unemployment, I was curious to see like, okay, where is the history can tell us? The highest unemployment that we actually ever had was 14.9%. That was when the COVID happened in April 2020. In 2009, we were at 10%. 1982, we were at 10.8%. And the lowest unemployment rate that we had was in 1953, was 2.5%. That's why I said we're still way below average on unemployment, even at 4.2%. But I just wanted to share with you this chart. And in the lowest from the 5-year period were in April, 3.4%. So that's where we were. So average hourly earnings would be the 4% year over year increase, and month over month 0.4%. GDP. So now we have our final numbers for the GDP. So this is for the third quarter of 2024. And we actually annualized rate at 3.1% for the GDP for the third quarter of 2024. The deflator rate, its index, is actually how much the inflation increasing in the pricing. So it's increased by 1.9%. So it's, it's not as increasing as quickly as, thank God we don't need it, right? So if we go take a look, the GDP sales Q3 final, that would be 3.3%. And the real consumer spending for the Q3 is 3.7%. So like I said, the consumer's still there, still going in. The PCE, we close at 1.5% for the quarter, and the core closed at 2.2% for the quarter. So corporate profit is still here, and it's a little bit fell by 0.4%. But as you can see, the corporate profit is still really strong, and we for this period we have $3.128 trillion in corporate profits in the Q3 of 2024. I hope you enjoyed this video. I hope you find this video valuable for you and for your family. If you do, please don't forget to subscribe to the channel below. My name is Anna Eckstein, Coldwell Banker Realty Ultimate Luxury Group. My phone number 404-222-8101. Thank you and have a great day.